So I've given you all the PowerPoints. I think everything's up there now. If there's a hole, let me know, but I'm pretty sure I've got it. So work through all of that stuff. That study guide that I made up for you, I think is a pretty good study guide. So if you'll go kind of bullet point by bullet point through that, I think you'll help yourself get ready for Saturday probably as well as you can. The format of the exam is going to look a lot like your midterm. There'll be some objective, kind of multiple choice stuff on there. There will be some quantitative exercises for you to do, and then there will be some more like short answer essay type things for you to work through. So again, I think no great surprises. I am here every day, pretty much all day as far as I remember, next week. So if you need to consult with me about anything, because it's exam week for all, as you know, exam week for everybody, that'll be kind of my first priority to try and make time for people who have questions. So there you go. All right. Now, I just want to kind of end the discussion that we had before breaks. So what I showed you or argued before the break was that there's kind of the hybrid system that we have now is kind of a good news, bad news scenario. And so a good way to kind of capstone, I think, this is to just ask not about whether we approve or disapprove of the hybrid system that we've inherited for the past 40 years, but rather what are the advantages and disadvantages of fixed versus floating exchange rates. And kind of the way I like to think about this, especially when I'm in an MBA context like this, a lot of you, at least I hope, are going to have careers that involve some degree of global economics. That you'll be working either for a foreign country or an American country that's doing business with foreign countries. In fact, it'll be pretty hard to avoid working in the global environment. So what I wanted to do was maybe end by giving you kind of a take on what are the advantages of countries that have fixed exchange rates relative to countries that have floating exchange rates. So the story kind of goes like this, and the way I want to think about this is let's just have a debate. And the debating question is going to be this, resolve fixed exchange rates are better than floating exchange rates. So let's see what arguments you'd make on either side of that. Okay? So if you were arguing that fixed rates are better than floating exchange rates, here are the points that I think you would want to emphasize. So the first one's actually pretty obvious, especially when you're thinking about doing business in a country or with a country or companies in a country that have fixed exchange rate systems. And the obvious advantage here is that when you eliminate exchange rate uncertainty, you've eliminated one significant part of risk. Okay? So think about countries or companies that do business within the Eurozone. An Italian company can sell goods to a French company and can accumulate receivables or payables denominated in euros and not even have to think about exchange rate risk. If we had an Italian company that did business in lira doing deals with a French company that did business in francs, and the currency floated, then there would be exchange rate risk. So I think this is an obvious point, but it's probably the most important single point. When you have a system of fixed exchange rates, you basically reduce exchange rate uncertainty. Okay? The second advantage of fixed exchange rate, this is more subtle, but it's still, I think, worth mentioning. When a country has a fixed exchange rate, they have in effect made a commitment to maintain a certain monetary discipline and to follow a certain monetary policy. Okay. So again, I'll go to Europe. All right. Several countries in Southern Europe are, to put it gently, not doing well right now. Italy, Portugal, Spain, especially Greece, are all suffering, is the right word? The temptation is for those countries, or would be, for those countries to pursue a very aggressive, very expansive monetary policy, effectively to try and inflate their way out of the crisis. The fact that Greece doesn't have their own currency and Italy doesn't have their own currency and so forth means that they can't do that. That they have to maintain, they are committed to a responsible monetary policy, or at least the monetary policy that comes out of Frankfurt and not their own somewhat short-sighted, potentially short-sighted, simple thing. Okay, so that commitment to monetary stability that comes with a fixed exchange rate is that's a good thing. All right, so those are, as I say, those would be if you were going to argue that fixed exchange rates are good, those are the two arguments that I would give. What about the other side? Fixed exchange rates are bad. And I think you're going to hit several points here. One is that when you fix your currency against another currency, and that currency changes in value, your currency changes in value. So I talked to you before the break about the problem in Argentina in the very early 2000s, when they fixed their currency against the dollar appreciated. Okay? A more modern example of that is being seen today in the Eurozone. Okay? Again, we almost don't think about it this way, but the right way to think about it is that Italian currency, and especially Greek currency, is fixed against Germany and France and all the other countries. Okay? If the euro appreciates in value, then effectively that country's currency appreciates in value. So let's think about Greece because that's by far the best example of this. If Greece had their own currency, if the drachma was in existence and used in Greece instead of the euro, almost certainly what would have happened is that the drachma would have depreciated in value against the US dollar and pretty much every other currency in the world. What would that have done? Well, that would have stimulated probably the two most important export industries in Greece, which is tourism and shipping. Okay? Taking a vacation in Greece would have been really cheap in a world in which the drachma was around. Shipping your containers on a Greek cargo ship would have been really cheap if the drachma had dropped in value. Okay? Because their currency is fixed against the euro, and the euro hasn't been depreciating, at least not to the extent that a Greek drachma would be depreciating. Greece can't use the exchange rate mechanism in a way that would normally be used to accommodate their own, right now, disastrous conditions. So that's a disadvantage. All right. The second disadvantage is kind of the flip side of the advantage of fixed exchange rates, and that's the inability to conduct independent monetary policy. And really, again, I can come back to using Greece as the poster child, but I could pick really any of those southern European countries. The fact is that they can't use monetary policy to try and lower interest rates to stimulate their economy, and that's a problem. The third disadvantage with fixed exchange rate systems comes back to what we were talking about before the break, and that's the possibility for catastrophic disaster. When a fixed currency arrangement breaks down, it tends to break down catastrophically. So, again, go through the list. You think about what happened in Mexico, Asia, and Argentina. We could also use Russian bond default as an example of this. When the currency breaks down, things go really bad really quickly. And in fact, if you have any takeaways at all from what I've talked about all morning, I would kind of hope that it's that you understand that the way the global financial system works today, if things fail, they tend to fail catastrophically and very, very quickly. So if you're, if you're doing business, whether it's operations or finance in the global economy, you have to be aware of that potential. All right? Okay, so that's all about the international monetary system. Get rid of that. The last thing I wanted to talk to you about is, actually in some ways we're coming almost full circle. Very first class, I talked to you about measurement and how do you compute gross domestic product and so forth. And I'm going to circle back on that. I want to talk about how we keep track of the international monetary system and trading. And so I'm going to talk to you about balance of payment accounting. And I should lay my cards on the table here. One of the reasons that I wanted to go through this lecture, and I try and do this with all my macro classes, and sometimes I almost repeat it when I do international finance, is because there's a lot of ignorance about this point. I'm not accusing you of being ignorant. We'll find out on Saturday. There's just, I think, a fundamental misunderstanding of what these trade statistics really measure. So I want to explain to you what the trade statistics are, and most importantly, try and get you to understand what they do and they don't tell us. Okay, so balance of payment accounting. So here's kind of just the definition of what we mean by that. The statistical record of a country's international transactions over a certain period of time presented in the form of double-entry bookkeeping. Okay? So immediately people are seeing Susan Wright appearing in their background. By double-entry bookkeeping, I don't mean quite in the accounting sense, although, well, maybe I do. Let me just explain why this matters. So the way we keep track of international flows is that we record anything leaving a country as a credit and anything flowing into the country as a debit. So outbound is credits, inbound is debit, and every transaction, this is the double entry part, every transaction has both a credit and a debit aspect. Okay? So, happy fantasy. You're about to buy a Ferrari. Okay? When the car comes into the country, the value of the car that's being imported will be counted as a debit. Of course, you have to pay for it. Let's suppose you're a drug dealer and you just send a big suitcase full of cash outside the country. When the cash is exported, it seems funny to say it that way, but that's what's happening. When it's being sent out of the country, then the cash leaving the country is recorded as a credit. Okay? So inbound debits, outbound credits. Now, the other thing to understand about the balance of payment accounts, and by the way, I'm simplifying just a little bit here, but I'm not missing anything big. There's just some subtleties in the way the actual statisticians keep track of things that aren't worth our time. Okay. The balance of payment accounts are designed to record all of those transactions, and for all intents and purposes, the balance of payment accounts are divided. We keep track of two different things. We keep a so-called current account, and I'll explain that, and then we keep a capital account, and I'll explain that. So the current account includes all the merchandise trade. So that would be raw materials, manufactured goods. The current account also includes services, and services include tourism services. So if you go to London for the holidays and stay in a hotel room there, you will be consuming a service. That will be as if it's imported. Transportation and so forth. Okay. Current account also includes, this seems somewhat mysterious, but I've got a little example here, income receipts, which includes dividends and interest. And then the last thing, turns out it's important, is unilateral transfers. Okay. Unilateral transfers, let me take a minute. These are payments for which there is no counterflow, or no tangible counterflow is a better way to put it. So the big example here is, say in the U.S., if someone works in the U.S. and earns money, and that would be legally working in the U.S. or illegally working in the U.S., and they send their money back home. So a Mexican working in the U.S. with family back in Mexico might send $50 a week back to Mexico. That is a unilateral transfer. The other big place where we see huge unilateral transfers is in the Mideast, where we have got guest workers from mostly Asia who are working in Qatar and Saudi and places like that, sending money home. All right, so that's the current account. Then the capital account includes all this stuff. Direct investment, things like the acquisition of plant and equipment, or controlling interests by the acquisition of equity, portfolio investment, which are just what the name says, portfolio investment in bonds, and then the capital account includes some other stuff like bank loans, trade credit, and importantly, at least in our treatment, you could put in the capital account all the reserve assets, the movement of reserve assets, like movement of gold and monetary reserves. Okay, so that's the capital account, and that's the current account. Now let me help you see what matters with all of this. Okay, actually, let me make one other point. Real quickly, just so you'll know. Depending upon which statistical reporting agency, they may segregate out some of these items. So depending on whether you're reading IMF or some other, they may put, or BEA stuff, they may put official reserve assets in a different category. Don't worry about that. Do understand this. You probably know this, but I want to clear up any confusion right now. What we mean by a sovereign wealth fund is different than a country's official reserves. Okay, so sovereign wealth funds are not the same thing as official reserves. What a sovereign wealth fund is a government-controlled investment fund. So if you, the best example of this is Saudi. Okay, the Saudis make a lot of money, obviously, selling oil. And most of that money is, or a lot of that money is owned or controlled by the government. Okay. That is reinvested in stocks and bonds and real estate all over the world. That investment fund maintained by the sovereign is what we mean by a sovereign wealth fund. That is different than the country's official reserves. So the People's Bank of China has several $100 billion in dollar reserves. That's different than the sovereign wealth fund.
So the official reserve account is more like the U.S. Treasury, is that correct?
Yeah, that would be, actually in the U.S. it's actually owned by the Federal Reserve. Okay. But it's effectively controlled by the Treasury. Okay, so let me go kind of do a little blackboard exercise for a minute just to help you better understand what's happening. So I want you to consider, let's do 3 transactions, or maybe 3, whatever. So transaction number 1. Let's suppose that the U.S. exports, to say, $200 million worth of goods and services. All right, let's see how that would be handled. And let's channel Susan here for a minute, and let's actually do the T accounts. Okay. Now remember, we make a distinction between the current account and the capital account. So I'm going to have to do 2 different T accounts. Okay. So here's the current account. Then I'll do another T over here. This is for the capital account. Okay, and every time I do this, I have to remind myself. Does it go debits and credits, right?
Yes.
Oh, good. See, I shouldn't have hesitated. All right, so the current account. So let's think about this export. So the exports, the goods themselves are leaving the country. Remember what I told you? If a good is leaving the country, is it a credit or a debit? Outbound. It's a credit. Outbound is a credit. So what we're going to do is come over here to the current account, because remember the current account includes all the merchandise, trade, and services. So this would be an entry for the current account. And we're going to record that as a credit. So that'll be 200 million. Okay? Now, whoever it is that we're selling this stuff to has to pay us. Okay? And when they pay us, they are probably going to give us some form of a debt instrument. So they're probably going to, I don't know, maybe just write us a check. Well, a check is a debt instrument. If they give us, if they're drug dealers and they give us cash, remember what it says on a note. It says it's a note. It's a debt instrument. Trade credit, long-term credit. However we're going to get paid for this stuff we are exporting is probably some sort of a debt instrument. Right? Now, where do we record debt instruments? Current or capital account?
Capital.
That's a capital account item. And if it's incoming into the country, is it a debit or a credit? It's a debit. And it better be a debit because, one's got to offset the other. So, transaction number 1 will be another $200 million entry, but as a debit to the capital account. Okay? Of course, if we had exports, if we had imports, it would just be the mirror image of this. Suppose we imported $300 million. Okay? So we would record that as a debit to the current account. It's trade goods or services, they're leaving the country, other way, they're coming into the country, so that's a debit. And again, the same idea, we pay for it. How do we pay for it? Probably by issuing a debt, not probably, definitely by issuing a debt instrument. The debt instrument's leaving the country, so that's fine. Okay? Now, maybe one more, just to make a smaller point. Let's suppose that a U.S. company made, let's do it the other way. Let's suppose that a foreign company makes an investment in the U.S. So, Toyota, suppose they decide they want to open up a manufacturing facility in Frisco, right? Frisco needs some blue-collar industries. So let's suppose that transaction number 3, a foreign